All right. Good morning, everybody. There was a little bit of news from UPS and RXO. Popped RXO, likely see UPS fade a little. Kind of flat, little green around the world, depends on where you're looking. NASDAQ is flat. Japan also, S&P right behind that. Hong Kong, small caps. Really, the Dow up 0.25%. Kind of an outlier. The UK up 0.5%. And Euro stocks up 0.75%. So a little bit of a rebound, possibly on the Euro side. Hurry up and wait on our side, like everybody's just trying to take measure. Take a look around. Lots of Fed speakers this week around the world, not just here in the US. Still don't know the new message they're trying to pound into the table. It's been the same message forever, holding rates, not cutting. There's going to be a big data point this Friday. So as we get closer to it, we will get into a hurry up and wait mode where we expect the market to hold sideways in front of that PCE deflator. But that'll be later in the week anyways. Auctions in front of all of that. We got auctions today. So, Yellen's been out chipping teeth. We'll see how it goes today, what kind of results we get out of this, and how the market responds to it. And we're going to get a little data out of Japan tonight. And I know they're not showing it as highly impactful, but it's certainly one you're going to want to keep your eye on. All things considered, though, it's really quiet. Look at finance juice, how they're all just stacked up, all these different Fed speakers. Now, ignore the time frame that you see because it's based on my time zone. All these other ones we were looking at are for market time, East Coast time, but on finance juice, it's set to my time zone. But still, that's a lot of Fed speakers. So looking at the pivots this week, the daily and the weekly pivot are really close together. The market is starting right at its weekly pivot point. Last week, we got a considerable distance away from that pivot. There's the weekly pivot all the way down there. See how far we got from it. I've tried to quantify how far is too far when it comes to the market getting away from its weekly pivot point. And I don't have a really good answer, but it is something that I keep track of. When we have, a good week and the market makes an exaggerated move in either direction, one of the things I'm considering is how far away from that weekly pivot point are we? And do I think we're going to have anything left? And keep in mind, these pivot points, they don't move the market, right? They're not responsible for the market doing anything. But if you think of the analogy of a runner trying to run up a hill, the farther we get away from this, the more we would be stacking weight on that runner for him to carry. Someone said the other day, it's like a tractor pull. If you've ever been to one, the farther away they get from the starting pulling point, the more difficult it is to pull. Either way, if it's a runner or a tractor, the farther we get from this weekly pivot, the harder it is for the market to continue, whether it's up or down. The farther away we get, it's just harder and harder and harder. So at some point, you have to start to consider how much farther can we go when it's already made, some exaggerated moves. And we've seen examples where the market will do some outlier event, 2, 3 standard deviation moves. It's possible that we can go farther than the norm because the norm is where we get our averages. It's It's what we look for the market to do most of the time. So I guess the key difference would be trying to spot when today's going to be outside that normal range, when it's going to do something it normally wouldn't do. With both of the pivot points so close together and right there with price, we're basically starting in the center of the basketball court. We can free run to either side. We're not constrained from a week where we open already gapped up. Take last week or even the last 2 weeks. When we started on Monday, we were already a considerable distance away from the weekly pivot point. And that's not true this week. This week, we're starting the week right there, right at the pivot. I guess we can even say it's been 3 weeks now, 3 Mondays in a row where we've opened a considerable distance away from that pivot point. All bullish, by the way, right? It's been a really nice run. But we're opening this week right at the pivot. That by itself isn't bearish. It just what comes next will lay out a bearish or a bullish posture. And generally speaking, we're bullish above the weekly and we're bearish below it. That's kind of a real generic concept. It wasn't hard last week or even the last 3 weeks to consider the market bullish as we were holding above that weekly pivot. But there was some really good moves to the downside through all of that. So, that generic concept only gets us so far. When we're in a transition period, we're swapping from above to below and crossing through this level multiple times. That little generic phrase becomes almost worthless at this point, because we wouldn't want to trigger longs or shorts based on whether or not we happen to be above or below that weekly pivot. Because as you can see, we can crisscross through that level multiple times. We need to expand away from this zone to really get some context around that weekly pivot point. The central channel is opening beyond the previous central channel, so we have that. And the ranges are fairly narrow. They're not as narrow as they could be, but when you have a narrow channel, it implies that the market could make a reasonably decent expansion. When the channel is wide, we expect the market to not really expand, to kind of go sideways. Still waiting on spot gamma levels to see what their gamma index is. It was really high on Friday, 3.8 something, I believe. It goes as high as 4 and as low as -4. -4 says we can expand, and we probably will expand rapidly, whereas a +4 implies that we won't go anywhere. It's more that sideways, hurry up and wait sort of numbers. So looking for the numbers this morning to see if it's dropped from that 3.8. That's a pretty high reading. Looking at just the floor pivots, we've already tagged the S1, managed to hold above it. Crisscrossed through the pivot point multiple times, so we don't have any sort of MDP. We're not going to open, at least at this point, beyond either the R1 or the S1. And if we remain sideways, it's very likely that the S and R level is going to be all we get. 55.50 to 55.20. So 30-point range is relatively tight for the S&P. We have an average daily range right now of 53 points. So that would really be constrictive. The ADR levels are 55.65 and 55.11. So 10 points beyond the S&R levels. Both gold and crude has made some reasonably decent moves last week. They may be the better play if we sit in this sideways chop. Still watching the 10-year. It's trapped inside of Friday's range. Need a tail to see what we're going to do here. Inside day breakout, either direction. The thing is, we really don't want this moving around. Same with the dollar. We'd rather they just hold their levels and not move, rather than trying to discern which direction we want them to move. But right now, it still does look like the 10-year wants to break back to the upside. I think staying below 4.3 is just a line in the sand. We won't really see a change in market structure if we see the 10-year stay below that 4.3 level. For the dollar, it got real close to that 106 last week and rejected. That's going to still be our line in the sand this week, which is basically an inside breakout to the upside. If we break Friday's high, or even just call it last week's high, and get into a new high, I think the market structure will start to shift. Otherwise, we're not even to the midpoint yet from last week. And we want to see how the market responds to that halfback level. We've already came down and tested it. Whether or not it's going to hold will carry a lot of weight into the rest of the markets. Just remember, a year ago, maybe a year and a half, every time the dollar moved up or down, we were feeling it. Penny to penny, tick to tick. It was responsive. It's not like that anymore. So we're not looking for every little move, every shift in price up or down. It's more of key levels, identifying levels where market dynamics would likely change if the dollar goes beyond a certain point. You can see the ES and the NASDAQ has been maintaining after crossing underneath that white line. It's the 3-day moving average. If we're going to get any sort of a rally, got to get above that. Very likely get above it, pull back against it and test it like a Busby. Then rerun towards Thursday's high and expand beyond that last week's high. We'll try it. We'll see if they got their charts fixed yet. Nope. Still holding above the 10, well above all the stack, the 20, 10, 50, 200. We're above everything. For a key level this very big week day here, the 17th, be that Monday where we really expanded. Right now, that's the biggest level that we can focus on, the biggest candle. See that 50% still holding as structure. And it's not perfect. We continue to test it. Liquidity resides on the other side of the pivot. So we've been able to overshoot it, get into liquidity. It's been bid right back up again. We don't know if they're still defending this level, but by all indications, they're still there, right? So if this was going to be a bigger sell-off, which there's been a lot of talk about, we've topped out, the Mag 7 is tired, the broader market isn't picking up the slack, and it basically has its hands tied and can't. That's pretty much sums up what we've been seeing out there. If this is going to roll over, then they're not going to want to roll it over and dump it because they don't want it to move too far too fast, right? It would pick up speed later, but it takes them time to get out. right? So we'll get those moves to the upside with that digestion. What we see a lot of times is it'll make the moves in the pre-market, say, make a run up and then get into the regular trading hours, drop back down below the previous day's close and close lower. That way we're slowly working our way to the downside until they get out of everything. Then it starts to pick up speed. Now you could also argue, oh, it went below the 50, so that triggered a lot of selling structure. I wouldn't argue with it. It's not necessarily something I'd want to lean on, but there is some logic behind it. A lot of textbooks will point out the 50 as a key level, especially on things like the indexes, sectors. So breaking below that and seeing a significant sell-off makes a lot of sense, but we're nowhere near that level, right? So we could have quite a bit of selling and we would still be considered in trend. We would have to fall a considerable distance to even be outside of that trend. Now, there's a number of different ways to define where the mean is, but even using something like a regression line, and we just use that November low, we're at the midline of the regression channel. The 10-day works good. You can also use the 10-week. We would need to get below 53.30. That's 200 points to the downside. It's a considerable distance. Now, rather than just using things like moving averages, I like to use what they call pure price and instead focus on higher highs and higher lows. If we think about, back when we were in that sell-off mode, it still started with basic structure, went into a pattern that was expanding. We broke that to the downside and we set that low. It wasn't a lower low yet. We just set a low, it's a higher low, but we set that lower high. And then we broke structure. We broke that higher low and the lower low, which gave us a new low. And it never pulled back. We didn't get another lower high. It just sold off. A significant sell-off. When we did finally get one all the way back here, there's our second lower high. But the market didn't wait for it. It just cut through everything and just dumped really hard. Generally speaking, you're going to get that 1, 2, 3 fail, or at least lower highs, lower lows, outside bars. You'll get some signals in the indexes, maybe not in the equities, but in the indexes. So we'll breach a low with a new low, get a lower high. We'll breach that low with another low, get another lower high, right? Then it sells off. Well, right now, all we've got is a high. We don't even have a lower low yet. So plenty of room. So we are going to want to keep our eye on that broader market structure, see if everything else is going to pick up. And there's equal weighted versions of the S&P and NASDAQ. A lot of places like David Keller often points out the difference between the weighted and the unweighted S&P for an example in his analysis. We need to see that unweighted sector start to pick up, and it turned green last week. It hasn't been green, but it did turn green last week. So we might see a little bit of daylight there when it comes to the broader market broadening out in this run. We'll see. The money's got to go somewhere if it's going to leave the Mag 7, right? Whether it goes into defensive names and we start to really get a pullback, or whether it broadens out into the other names, that's really what we're trying to witness. When it comes to CEOs or anybody selling a significant chunk of their shares, you always want to dig a little deeper and find out, did they just acquire a new set of shares, right? Did they get a package? Were they gifted something as a part of their compensation and then they sold it? Was it already on the books as a regularly scheduled sell? Or, you know what I mean? They can't just log into their broker and sell the way you and I do. They're bound, and there's guidelines to how they sell and when they sell. So usually if it's public knowledge that a transaction even took place, somewhere in the documents, it'll also kind of lay out if it was a surprise, if it was part of a package, you know, because otherwise you can see selling from a major figurehead, CEO for an example, and consider it with a bias. Oh, that's bearish. The CEO just dumped a bunch of shares. He could have had that on the books to sell if XYZ price was triggered, or every year at the start of the new quarter, anything like that. And then it suddenly removes all the bias, because then it's just another day at the office. We don't really have much in the volume structure. 3 Ds. Each one of these high volume nodes shapes a D pattern. This is more noise than anything else. We're going to lose volume across this lower structure. And that's not where the point of control is. So we're not going to see a shift in the point of control unless we get a lot of volume at our current location. So if we hold this zone, this 55.70 to 55.20, it's a 50-point range. If we hold through here over the next day, maybe two, we'll bring the point of control up to us, and that'll be, in my opinion, bearish. If we maintain above this and continue to expand higher, then it'll continue to act as sort of a psychological support level. It would be called that because it wouldn't be support if we never hit it. We never even tested it as an actual support, but it'll be perceived as a support level. A lot of people like to get in on support, whether they name it support because it's actually been proven to be support, or whether they just assume it's going to be support. So, you know, getting in above the point of control, as long as that point of control stays below us, it can still be considered bullish. But if it does move, if we stay here long enough for this point of control to move up, and now it's tangled up in right where we are in price, that'll be considered more of a bearish structure. We won't lose volume where the point of control is right now until Wednesday afternoon into Thursday. No VPOC to carry forward. We've already crossed through that zone multiple times this morning. We still have 54.88, which I believe was from right around the time we started to change contracts. I'm willing to leave it on. It doesn't hurt anything to just let it sit there. But those older values, those older levels, they don't really hold much weight if the contract where they were created isn't here anymore, right? Where's the unfinished business if that contract is already gone? Now, sure, a lot of them are just going to roll into the same number where they were before, but that's making an even greater assumption than the assumption that POC actually has any weight today. The textbooks, I continue to try to point this out, though I don't do it enough. The textbooks will tell you when you have a volume profile from yesterday, mark the high, the low, and the center point of control, and project those into the day's trading range. I don't do it. I've already got enough pivots. But if you didn't have enough pivots, or if you want pivots, then marking out that structure from Friday and plotting those across the screen, doing that every day, it's not a bad way to go. I've got enough pivots. I don't need any more. And there's a bad habit that I've noticed where, people just mark the high, the low, the close, just marking pivots everywhere, daily, weekly, monthly, volume profile, ADR. The next thing you know, you got 150 lines all over the place. And no matter what price does, it's going to hit one of them. What are you supposed to do with it at that point? Just loses its structure, its value. We got our new week. Last week, when we measured this range, it was significantly bigger than the range that we just had. On one hand, that's not much of a surprise because it was a short week. And so it shouldn't be hard to beat a short week when it comes to the amount of volatility priced into the market. Okay, that's a given. But on the other hand, that short week had more volatility in it than the week before it did. Now, when we measured it on Friday, it didn't count. It only counts until after the close. So now that we're past Friday's close, we can measure this range, compare it with last week's range, and ask the question, is the current week's range bigger or smaller than last week? These ranges are built based on volatility. So the more volatility there is, the wider the range will be. It's also based on time. So if it was a 3-day week, it would be smaller because we just don't have as many days of volatility. So it's time and its volatility. The new week compared to last week has an extra day. So seeing a little bit more volatility makes sense. The only thing that I would add to that throws a little wrench into the idea that it's only an extra day that gives this more range is the fact that last week's 4-day range was bigger than the previous week's range of 5 days. So the argument would be that we're still seeing volatility pricing into the market, even if you don't see it in something like the VIX. And I get questions like this often, and I understand your confusion. I'm saying volatility is up. The VIX says, no, it's not. I get it. The easiest way to just uncomplicate all of this, think of the S&P, the SPX. It doesn't have share volume because you can't trade it, but you can trade its options. There's so many volume tools out there, on balance volume and a MACD based on volume, and there's just so many volume tools, but you can't apply most of those to the SPX because, well, there's no volume. There's only options volume. One of the things we can do, though, is we can monitor that options volume. That's what the VIX is doing. The easiest way to uncomplicate the VIX is it's just SPX options volume. That's it. If you dumb it down to that and take another look at the VIX, SPX options volume, 30 days out, because there's a lot of options and you got to try to figure out, well, which options are they looking at? The SPX is looking 30 days out. or the VIX, I should say. So take the SPX, go 28 to 30 days out, look at the implied volatility average. There's your VIX. Now, the market's not open this morning, so I doubt the VIX is actually sitting at 13.47 or 1297. But once the market opens and these numbers normalize, you can easily see where the VIX is at any time just by when you're on the SPX options page, is just look to the right, because that is what the VIX is. The VIX is not, quote, volatility in the way that you would think of it as price movement. So when we're looking at this range and the range continues to get bigger and bigger and bigger, and I'm telling you that volatility is expanding and volatility is increasing and the VIX isn't moving, it's not that one of us is wrong. We can both be right. Volatility is a very fancy word for movement. Every time you hear the word volatility, just replace that word with movement. And implied is another way of saying promised. Implied volatility, promised movement. Historic volatility, previous moves. So the moves between one candle close and another candle close, that's what the implied volatility is. If you put the implied volatility indicator on a candle chart, that's what it's looking at. How far have we moved from one candle's close to the next candle's close? They did a disservice by naming this an implied volatility indicator. They should have called it the candle close indicator. It would have been less confusing to people. We're still more than 3% above the 10-week. So we're in our sweet spot. That's exactly where we would want to be. All this talk about selling off and topping out and all of that, I'm not saying that that is wrong. Just when we were sitting at 3% from January all the way through March and into April, that's where we were hovering, is right about 3% away from the 10-week. And we stayed there through that whole run. Now we're right back in that sweet spot again. And we're fading off a little bit, to be fair. But we're still in the sweet spot. We don't want to get too far away in the 10. But we do want to maintain a reasonable distance from the 10-week. On the 10-day, we're less than 0.5%. So this is basically year to date right here, distance from 10. We've gone as low as -2%. So we were 2% under the 10-day moving average. And we got almost as high as 2% above, which makes sense because if you go through any sort of indicator classes and learn up on things like RSI, for an example, that has a plus and a minus and a 50 value, they'll talk about reciprocation. You know, like if you get a 12 on the RSI, then you're due like a 88 on the other side. Or, you know, you get an 85 on one side, you're due a 15 on the other side. Weird maths, right? That's what it comes down to. Weird maths. But a lot of times those maths play out. Getting a -2, if we're looking for reciprocation, we'd expect a +2. Just because that's what it does. Even just the distance between the VWAP, right? We talk about reciprocation in the VWAP all the time. We had it in the overnight. We went X distance from the VWAP on one side, so we flipped around and went X distance from the VWAP on the other side. Reciprocation. So right now we're still on the fade back. Everything looks healthy on our distance from the 10. We're maintaining above it. we don't really even have to go to it. We just have to stay in one spot and the 10 will come to us. Resetting against the 10 is considered a good thing on the daily. It's where we continue those drives to the upside. We were just talking about from January through April, and you can see how often we came back and tested that 10. We'd make a nice move, retest the 10, make another nice move, retest the 10, and we just stayed in a nice, clean, healthy advance to the upside. Never really getting parabolic, just grinding higher and higher. We got a lot of reasons to be concerned. Absolutely true. There's a lot of bricks right now in the wall of worry, but there always are bricks in the wall of worry. And most of those clickbait headline doomsayers out there, most of it doesn't pan out 99% of the time. Some of the arguments, sound really good, and then they still don't pan out. I'll just stick with price. Bitcoin did break some key levels. Got a notice this morning it was under 61,000. So that opens the door for some nice shorts in the Bitcoin proxies. Riot, Mara, Coin, MSTR, Hut, Hive, Hood. All of those are fair game for if you're going to short Bitcoin or Bitcoin proxies. Nat gas is down. That's not a surprise. That $3 mark on spot really just held like a champ. Tech and semis are down. A little bit of a mean reversion, possibly. We need more on that. And things that are up. What's up? The VIX is actually up a little bit. Biotechnology continues to just shock and awe everybody. There's always a wild card somewhere every year. I think they'll be talking about 2024 for a long time when it comes to what we've been seeing in the biotechnology space. Gold and gold miners, they're skirting the edges. They're not quite up 0.5%, which is our benchmark, but I bet as we get closer to the open, they will be. You can always circle back and do this on your own, right? Look at the things that are gapped up as we get closer to 9 a.m. Seeing a little bit of energy exploration and that sort of stuff, but they're not up enough. Same with finance. They're up a little. A little doesn't count. We need at least 0.5%. All right, so we got crude here. We could use, CL, but either one. You can see the chart really doesn't change. We've set that high like we were talking about in the S&P. We had an equal low, set a lower high, and then we broke that low. So there was our structure break right there. Really started to expand to the downside. You could consider it, a little bit of like a left shoulder head, right shoulder neckline break, measured move. Things played out perfect. From there, we had this expanding pattern, flat top, lower lows. Then we had a significant breakdown, came back up to reset that breakdown back to $80. That was like a big liquidity grab. Now we're right back where we're fighting this 82 level. If we always want to think about unfinished business and structure, anything from back here is gone when we took it out. it'd be hard to believe that there's still any significant bag holders at this point, right? That they just have to be gone. But it's still a level of concern and area of interest. 82, if I was to scroll back even farther, there's been a lot of work at 82, a lot of work at 80. This whole thing, if we were to measure it, mark out halfback levels and all that, I think we're above structure at that point. Yeah, we made it above. So that $80 now has to hold and 82 has to break. We could get some pretty good moves. We had them back here nearly daily where we were getting some really good moves. This is the old adage about, taking the stairs up and the escalator down or the window. You see, crude is really good at grinding up and then just suddenly dumping. And those people that tell me I trade so much better to the downside, I always have a hard time trading long. That's probably why, right? Those days where everybody's scrambling to get out and fighting over themselves and the market just drops really clean. We're primed. If we can break 80, we could get some nice clean moves to the downside. Some more of these big days. That's why I'm pointing it out. Gold, we've been in this grind, this sideways mash trash for a while. Really not looking for too much to change. If we can break yesterday's low, Friday's low, and retest this 2300 and then expand below 23, I think we could get some really good moves to the downside. Just measure this last really big bar and project it to the downside. And if that's too far away and you want to tighten it up, we had a really big bar on the 21st. And it's the previous bar, so that works too. But as you can see, if we use that bar, it just lines you up and tells you to watch this big bar's low. Well, thanks, but we would have already been doing that if we'd have done what I said the first time. Otherwise, a rally in gold, watch out for 2355, 2356, basically. It's going to be a halfback level, and it'll be a significant level to try to get through. And gee, imagine that. It's the halfback basically for both this really big bar and for yesterday's bar. Either one. It's still 2355, 2356. So that's a significant level of resistance in gold, even if we get there. And it might make for a really nice rejection like we had here after we made this really big move, this big bar, and we rallied up and hit the halfback. Yep, there are, I mentioned earlier, we're going to be getting some auctions, and Yellen's been out chipping teeth. The ones that we're going to get first are all up in the front end, really, really up front. 3 and 6 month. Tomorrow, I think we get the 2-year. Yeah. So it gets better as the week goes on. All right, biotech has been fighting against this range, this 138. Call it 138 and a half. Every time we've got up there, it's been sold off. We got a really nice breakout started this morning up through that level. Now, this is a daily chart on the right side, and these wicks are after a market went that high and fell back down. I know that might be a little Captain Obvious, but the day isn't done yet. So watch biotechnology. This could be popping up there just to get up into this prior resistance and sell right back off again. There's a lot of examples, wicks all the way back here, and all of these wicks. Every time it's tried to get up into this level since, back in February when we got that high, and that's the last time we got there, all that selling, we keep getting that selling when we get up into that level. So maybe finally we've absorbed the liquidity. There's nothing left and we're going to make our way through it and continue higher. Yeah, maybe. I would be watching for the other side of that coin. Keep your eye on it. See if it demonstrates that massive selling structure that we've seen before. You could use something like measured move on this too. Even just measuring the range that we've had here. This is kind of a W pattern. It's a really ugly W pattern, but even just measuring this structure here gives us the 111, 1, 2, 3, 6, and the 1.5. For swing trading, the 1.5 usually fits best. But if you're trying to day trade it, then keeping your eye on that 111 as a warning center, it's very likely the first place it's going to reject, right? If it's going to fail, it's very likely going to be there. Crude's had a nice run. We're looking at USO here. Since June 4th, it's just been a nice march to the upside, pauses for digestion, but otherwise it's been looking really good. At what point does this, call timeout and take a break? We're already through the half back. We got a 786 level, but that doesn't hold a lot of weight with me. And even if we wanted to flip everything around, just focus on this last move here. The measured move down, the advance back up, and now the breakout. We made it through 111 and got close into the 1, 2, 3, 6. I'd say if you want to go long crude, we got to get above 80. And then there's the phrase, if 80, then 100. So get it first, get that 80, own it. Then we can focus on trying to get to the halfback or the measured move, 50% higher, 82, then 84, which would give us a breakout of this structure back here. There's a lot of trash in the way for that to happen. And we've already made some really big moves through a lot of trash. Some dark pool moves in China names. I don't see, normally we'd have KWeb if we're going to see China and emerging markets, but we're not seeing KWeb. So just looking at the China ADRs, go in there individually, big pre-market moves, dark pool prints, BABA, Baidu, same move. PDD, yeah, PDD is looking a little different than its peers. Still looks nasty. JD, same dark pool print, like they're getting traded in a basket. You can see that consistent, persistent sell-off in the structure towards this year-to-date VWAP. That's target. Oh, man, it doesn't get much cleaner than that. Where are we going? Back to the year-to-date VWAP, short into 26.5. It's almost a $2 move for JD. I like it. Just remember, you're kind of shorting from the hole. So, if you could get a pop up first, maybe try to close this gap against 28.5 and then short it. Probably like that better. But I have no doubt we're going to go down here and tag that anchor to VWAP, just like we did back here, right? We started the year underneath it. And when we were running to the upside, what was the target? Back to VWAP. Fought with it, got away from it. Same thing, back to VWAP again, again, again. You could see where the tide was turning. We started trying to get around, get to the other side of it. Once we did, started to sell off. Where are we going? Back to VWAP. That's very pretty. Sure is pretty. Uranium, Bitcoin, nat gas, airlines, tech, cloud, semis, utilities, agriculture, hot stocks, consumer discretionary. All of those are down. We're looking at the 9 sectors here. And in the corner of every one of these charts is a 5-day change. So we can look, kind of ask that question. What's the market done over the last week, over the last 5 days? Oil's down 1%. Building materials is basically flat, but down near a quarter. Under the 50, the other one's above the 50. These don't look like over exaggerated markets, right? They don't look like markets that have really been expanding too far too fast. Sure, you take a look at tech. Tech looks a little expanded past that 50. The 50 is the orange line down here. We had a bit of a runaway. But change over the last 5 days, it's not even 1%. And we've seen these numbers before at, 3.5%, 4%, 5% distance in 5 days. Those are big moves in a short period of time. I guess the wrap up would be just I wouldn't make any quick assumptions today. Let the market settle out a little bit, see what the Fed has to say. I doubt that message is going to change at all. We're still waiting for the spot gamma founders notes for this morning. Maybe some insight on the volatility trigger or the 0 gamma level would be nice. And watch the clock. It's a pretty boring day at this point. Even the volumes, sitting at 89, it's well within our normal range. So everybody be careful, be safe, have a good day. I'll see y'all tomorrow.